in Melbourne for the ISA conversation with Paul Keating. Greg Combet and Paul Keating are in Sydney. I'm in Melbourne, and courtesy of wonderful technology, we're able to bring this to you. Thank you all very much for joining us. And Greg, thank you very much indeed also for being on hand together with Mr. Keating. As we wait for everybody to join in, can you tell me about the latest ISA ad that you've been running on broadcast television and elsewhere? Explain the reason for it and how it's been received.
Sure, John, and welcome. Thank you for hosting this webinar. Yes, Industry Super Australia's got a campaign running at the moment that's informing members of the SuperFunds and the wider community, of course, about the contribution that people's superannuation savings are making to the economic recovery in Australia. And specifically, our ad campaign addresses the around $19.5 billion worth of investment that's planned over the next 3 years in things like commercial property, shopping centres and infrastructure within the domestic economy. And our work demonstrates that that's going to create over 200,000 jobs over the next few years. And it's pretty important, I think, that people who are members of the industry funds know how their savings are being deployed to help economic recovery and create jobs and provide a very strong return to their superannuation accounts. That's the purpose of the campaign.
Okay, and its effect, are you able yet to measure whether it's had any particular impact?
Well, I get stopped in the street by people again. So someone must be watching it. My mum's pretty happy about it. No, we do regular monitoring, of course, of how a campaign is received and what members of the community and members of the super funds are thinking about the campaign. It's pretty early on yet, but in due course we'll have some good data to reflect upon the effectiveness of the campaign.
And I'm sure this is what we're going to touch on in a moment with Paul Keating once we've got all 350 or so registrants signed up and ready to go, and that should only take another moment longer. But the superannuation's never been such a political hot potato as it is at the moment. It's quite extraordinary. It's almost every day there's another little flare-up, a little spot fire.
Well, of course, partly the reason for that, John, is that, excuse me, our retirement savings system now is so large. It's about 150% the size of nominal GDP annually in Australia, so it's a big pool of capital, significant investor in many parts of the economy. The industry funds alone, I think, own about 10% of the Australian Stock Exchange, the shares on the market. And of course, we're investors in every market domestically and big investors globally as well. So it's significant economically, and when we're in the midst of this grim pandemic, of course, the economic impacts and how we can find our way out of the economic downturn that the pandemic has induced is very important. And I think that's essentially why super is in the focus so much as it is at the moment.
Paul Keating needs no introduction, and I won't labour the honorifics with one. Paul, thank you ever so much for making your time available. And superannuation, as I just mentioned with Greg, it's constantly in the news, little spot fires left, right and centre. Can we cut to the chase first up? The super guarantee, there's obviously a backbench campaign from the ranks at the moment of the coalition to try and avoid and prevent the legislated guaranteed increase on the super guarantee. Do you think there is any reason whatsoever to take heed of any of the particular points being made? The Prime Minister over and over again says, well, it's people accessing their own money on the early release, and on the super guarantee they say, well, it's not the time to afford, business to afford this sort of an increase. Can we deal with those two big questions up front, please?
Well, good, John. Very nice to be here, and good morning to everybody. Well, look, the same things were said when I introduced the SG superannuation guarantee in 1993. Remember, it went up 7 percentage points at 1 percentage point a year out of the recession of 1990. We were still coming out of the recession of 1990. And a lot of the so-called economic commentators were saying, and particularly on the business side, oh, this is not the time, the nation can't afford this. Well, of course, it made the SG was completely affordable. We had the profit share in the economy rising as we had the wage share. We had strong growth in employment all through the 1990s. And the recession was quite deep and long, but Therefore, the notion that, and we're going up 1% a year in the 1990s, with the SG now going to a further 2.5% over 5 years, we're talking about half a percentage point a year. Half a percent. I mean, the national wage, the Fair Work Australia case this year was 1.75, so it's a third of that. Last year it was 3%, so it's a sixth of that. I mean, in the blink of an eye, you'd miss it. You know, it's so completely affordable. The other point is that there's been no real wage growth since 2013. Zero real wage growth since 2013. But there's been just on 10% labour productivity growth. 9.6 in fact. None of this has been distributed to wages. Zero. It all went to the balance sheets of companies. So what I think the proponents, and I'm one, of the SG going to 12, what we're saying is there's 10% labour productivity banked on the balance sheets of companies. We're asking for a quarter of it back. We're asking for 2.5 of the 10 back. Shocking. Shocking. You know, this is going to disrupt the whole economy. And then there's this sort of notion that, you know, we're not going to have a recovery. Well, of course we have recoveries, but having a big pool of savings, activated, dynamic pool of savings, which I can tell you I never had in 1991 or 92. Here's IFM out there today offering 600 million for investments in capital raisings in the economy, on the stock market today. An active, dynamic superannuation pool of this scale will spur the economy, and as Greg said, we're talking about a pool 1.5 times GDP, 150% of GDP. If you can't tap the pool at 150% of GDP and make the economy more dynamic, you've got to have a pretty good look at yourself.
There's been a wages superannuation trade-off as part of the negotiations over wages and awards and the like. Workers and trade unions, they've entered into negotiations predicated on the expectation that this legislated increase will go ahead. Yeah. What does it mean if it doesn't go ahead? Does it mean that in some ways, some of the fundamentals of the negotiations over the last few years have been on a false premise?
Well, the thing is, there's no economic case for it not to go ahead. None. There's a prejudicial case, as you say, on some of these baby-faced Liberals who've joined the front bench of the opposition, you know. I mean, there's nothing, you know, these first-term senators are a particularly modest form of political life, but they're out there commanding a half-page every time they want to in the Financial Review or the Sydney Morning Herald or the Age, you know, the old Fairfax papers. Look, the thing is this, John, anyone born in the 1970s, and I've got children born in the 1970s, will live now to 105 or 110. That's a fact of it. In other words, if they save for 40 years, from say 25 to 65, they'll be relying on the savings to maintain them for a further 40 years. Now, of course, this cannot happen. The pool of funds at 9.5% is way not large enough to do that, you know. So the argument for 12 is a very basic argument about adequacy, and of course, as we all know now, yields are coming down in a sort of a low inflationary, deflationary world. Mm-hmm. You know, we're looking at 10-year bond yields under 1%, government yields under 1%, and of course, corporate yields will follow those down. And so therefore, at some point, you'll get adjustments to returns from equities, yep, which will follow the yields down. Yep. So if we've got yields falling, people living longer, what case is there possibly for not having 12%?
And the burden on the taxpayer, on presumably a higher number of people accessing the old age pension and trying to live off it and living a dignified retirement, yep, has not been factored in either.
Well, when Peter Costello introduced the first intergenerational report, the Treasury had the call on the age pension at 4.6% of GDP. because of superannuation, it's under 3% now. It's 2.7, and it's falling towards 2.5. The OECD average is 8. Germany, France, the Netherlands are around 8 to 9% of GDP. We're under 3 and falling. You know, so the answer is you cannot have a decent income in retirement without self-provision. Otherwise, you'd have people on the pension, which is now, what, $23,000, $540 a week. Like, take my generation, the baby boomers. They wanted everything yesterday, and they want everything doubled now. If there were no super, they wouldn't be after 23,000. They'd be wanting 50 grand now, right? Now, so, of course, the Treasury, you know, the poor old Treasury, boring old Treasury, you know, always saying, oh, look, don't you worry, we're opposed to tax expenditures. Don't you worry about that. We'll handle the pension in 30 years or 40 years' time. Yeah. In other words, the offer is to keep people in penury. And I think the killer point is basically this, John. When I introduced the SG, 6.5 people between 15 and 65 maintain the income of one person over 65. That's fallen to 3.5 now.
In the workforce?
In the workforce.
Yep. 6.5
people between 15 and 65 maintain one over 65 in 1992.
Yep.
That's at 3.5 now and falling. So we'll reach a point where young Australians, there'll be only 3 of them carrying each retired person over 65 for the public pension or public costs, including health.
Yep, it's a bit like Japan, where they've got this ageing population and a diminishing, shrinking workforce to support it. Yeah. Unsustainable.
And you look at these young people, I mean, a lot of them are on low wages. B, they carry the HECS charge around their neck before they start.
Yep.
They carry the GST cold. They have trouble accommodating themselves. And we're saying, oh, by the way, you can look after the rest of us aged persons, the whole 3 of you. You can look after the rest of us aged persons. But by the way, the Treasury says we don't need savings for retirement. We can do it all on the public pension, you know. I mean, it's just fanciful nonsense.
Well, it's intergenerational stealth, really, isn't it? We're stealing, the baby boomers, you and I, dare I say it, are stealing from our kids' own generation. And if they get to the point of wanting to try and bid it for a house, we bid against them and use negative gearing to knock them out. But that's a hobby horse of mine. What would be the political response? Would you see that as being an issue as we start now to look towards the next federal election campaign? Does superannuation become a hot button issue like the Medicare, Mediscare was before, like negative gearing and the like, franking credits and the like at the last election? Does superannuation become a touchstone for the next election?
Well, I'm taking the Prime Minister and the Treasurer at their word, as they're saying they have no plans to change the SG, which is now legislated. See, the thing that we should focus on, John, is the fact this is legislated.
Yep.
The government has to do nothing but just let this thing tick up at 0.5% a year for 5 years.
Someone once said LAW law, I think, didn't they?
Yeah, well, it is LAW law, yeah. and that's good. Countries occasionally get a break. This country got a big break with super. We've now got the 3rd largest pool of savings in the world in absolute terms, not as a proportion of GDP, in absolute terms. We've wiped out the net income deficit for just about now. In other words, this is the first year since Governor Phillip came into Sydney Harbour where we hold more assets abroad than foreigners hold in us.
Yes.
First year. And that's because of superannuation. So you've got to be pretty willful to look past these core facts. A measure of Australia's resilience, true resilience, is not whether we're going to have another bunch of submarines or a couple of destroyers, but whether we are a capital adequate country, able to fund its obligations, but more than that, a capital exporter, which I think is where we're heading.
We will get to early release in a moment, but while we're on the politics of it, what do you think is driving then this backbench campaign? You mentioned before that it was first-term senators, There's also support, though, from some areas of industry and business. Super's always been there, and industry super now is well established. What's driving the animus?
Well, if super was today what it was before I turned up, and that is basically a lolly jar for high-paid private executives and people in the public sector, where ordinary people had no super, then I'm sure the Liberals will be out there barracking for it. You know, when Peter Costello had a chance, he took the tax off people at the top end and said you can put $1 million into it if you want to. You know, so that's been their sort of general view. But you see, when the industry funds got started, I think the Liberal Party said, "Oh, look, these little things we're not going to have to worry about. Then we still have our call centres, AMP, National Mutual, the 4 banks. You know, we can pick up the phone to any of these people." Well, National Mutual disappeared up its own orifice. You know, AMP has been billing dead people for years. The banks have come into the criticism from the Royal Commission, and all of a sudden, these little industry funds have bobbed up. You know, and the Liberals are saying, "Hang on, that's not in the playbook. That's not in the playbook." You know, where do they come from? Next thing, superannuation assets are now bigger than bank assets, and they like a bank intermediated society. But they don't understand that in a bank intermediated society, you don't have big infrastructure. You know, you don't have funding of all the infrastructure assets we've managed now with toll roads, you know, with airports, with ports. These sorts of investments couldn't be done in 3 to 5 years bank financing, you know. But the thing about the Liberals, I've always said that they don't understand capital. You know, they market themselves as the party of business, but you know, they don't understand capital.
Go back to early release then, in these exceptional times that we're in, Paul Keating. Josh Frydenberg made a big virtue, as did Scott Morrison, of the fact that people could access their own money, $10,000 last financial year, $10,000 this financial year. Yeah. There's already a bit of agitation to see whether or not that can even extend further. And I noticed in the news today, Greg Combet, sitting next to you there, who chairs ISA, said, no, the window should be shut by Christmas. What's your view, first of all, of the utility of the concept of early access, and secondly, whether or not it's been well managed as an idea?
Well, the key point is, I think, that of the income support in Australia to date in this COVID emergency, 32 billion has been found and paid for by the most vulnerable, lowest paid people in the country. That's the people who've taken the 20,000 out. And 30 billion has been provided by the Commonwealth under JobSeeker and JobKeeper. So instead of JobSeeker and JobKeeper carrying the main burden of income support from the get-go, what we're finding is that the main burden of income support is people, you know, ratting their own savings to the tune where now 600,000 young people have no, broadly young people under 35 have no superannuation accounts at all now. They've closed their superannuation accounts. So they lose all the compounding. The 20,000 would have multiplied itself by 5.5 or 6 times over their lifetime. So it's been, you know, a very poor choice for them.
So when they've been asked at press conferences or at interviews, either Josh Frydenberg or Scott Morrison have both several times used the talking point, well, it's people's own money. What can be wrong with letting people access their own money?
Well, if you take that, well, the logic of that point is, if it was all their own money to use as they please, there would never be any superannuation. Because the whole point of superannuation was a great public bargain for the SG that I struck with the community. That is, if you defer consumption for your working life, we'll give you a number of things. One, a very low rate of tax as an incentive. Two, we'll give you ownership of the funds vested in your name. And 3, you can have them managed and invested privately as you wish. Mm-hmm. So So this is basically the deal. The deal was, you defer consumption, we give you a low rate of tax. So therefore, people are in the position now where it's the government have said it's their money, but they haven't finished the sentence. It's their money accumulated under very concessional tax arrangements for one purpose, a retirement income. It was never. It's a breach of the preservation rules to just let anyone take 20,000 willy-nilly. As the Treasury admitted the other day, there's been no scrutiny on the reasons for the withdrawals of the 20,000.
But there's always been hardship provisions, and they've been accessed by people in the past for very specific reasons. This is arguably a national hardship. Do you accept that?
It's a national hardship requiring a national response, and the national response should have been a fiscal policy response, not the burden of the income support and maintenance of living standards coming from people's long-term retirement savings. But the main point is, you know, would you say to yourself, in a country with low levels of public debt to GDP, with very low interest rates, should young people under 35 be the principal carriers of the burden? Because that's what's happened.
Do you think the federal government is deliberately trying to change the narrative around super for members to have people think of their savings as their money as part of an anti-industry super ideology? Does it go that far?
Well, the key to all wealth is compound earnings. You know, in Warren Buffett's epistle every year, which he has, you know, he reminds everybody that the key to all wealth is compound earnings, the earnings on the earnings on the earnings. And generally we double, you know, our super funds in Australia have been doing 8 to 9% a year. In fact, the industry funds have averaged 7.8 over 10 years, let's call it 8%. So in about 8 or 9 years, that will double. The accumulation will double, you know. At the moment, the average accumulation in Australia per capita is about 230,000. So you'd say if we're able to keep up that sort of a run rate in returns, people will be just on touching 500,000 for everyone in Australia within 8 or 9 years from now.
Yep.
So this is the key of self-provision is compound earnings. That's why the preservation rule is there. That's why the compulsion is there. What is clear, if people are not compelled to save, they will not save. And so you do them no favour suspending or breaking the preservation rules, because it destroys the compounding and destroys their long-term retirement income. But more than that, it's putting a dent in the capital structure of the economy.
But the casualisation of a lot of jobs has meant that, in fact, the gig economy is a way of reducing business costs and overheads and forcing a lot of the maintenance of a business back onto the workers rather than the employer. Well, it's not how it's been seen at all.
Well, income inequality is the great poison of Western societies. Income inequality. And if we want to, you know, if we want to go down that, Australia, we've missed most of this because we've had high wages growth up to 2013. We've got a universal health insurance system. We had access and equity in education. We've broadly missed it. If you look at our American counterparts, people in the comparable workforce, they're in truly shocking state in terms of income inequality.
They are.
So if we want to be a society, a good society, which has bindings, each to the other, then we have to think about the sort of economy we want, the sort of society we want, and whether we then attend to the human face of labour in the workforce and not see it as before basically a job in manufacturing or something else. Every dollar that came out of the accounts of those young people, the 600,000 of them who shut their super, could have been funded by one press of the computer button at the Reserve Bank. One press. And you know, look at our debt to GDP, how low it is. the ability of the bank to hold these things on its balance sheet. I mean, this is the way, this sort of interaction is what the Treasury and the Treasurer should be doing with the Reserve Bank. This, rather than sacrificing young people in the way in which these early access schemes have done.
Peter Collins' question for you, Paul, is your successor as Prime Minister, John Howard, left your superannuation reforms, particularly industry funds, alone for 11 years. Given the unquestionable success of industry funds and the super guarantee, why now are they trying to reverse some of the fundamentals? Why is it now?
So the answer, the long answer to a short question is this. John Howard had enough sense at the time to understand the value, I think, of superannuation and the accumulation of savings, and was not obsessed about unions and union employer funds. But that has shifted. That has shifted to some extent. But how much it has shifted, we don't really know, and won't know until we see the first movement of the SJ in 1 July next year.
Okay, we'll get to the retirement incomes review in just a moment, and Greg Combet may want to join in on that as well. But there's a fair push and a bit of commentary surrounding super funds, in particular the smaller ones, needing to merge and have some rationalisation. There's also, in the midst of the pandemic, been some commentary, particularly from the Minister, from Senator Jane Hume, saying that some funds, because they're industry specific, are more vulnerable to economic events and downturns. If, for instance, you've got a fund that's entirely made up of retail employees, then when retail goes down the gurgler, as it just has, suddenly that fund is very vulnerable. Do you think there should be more of a rationalisation, and what do you think of forced mergers?
Well, I think that there should be rationalisations. And a lot of reasons why this doesn't happen is because of personality issues, people who are chairing funds and managing funds. I think all these things about encouraging the merging of funds into more efficient economic units, which of course then would diminish Minister Hume's concerns about over-dependence on one industry and one fund.
Yep. Do you think it's a genuine concern, that one?
I think so, and I think it's reasonable for. I think the superannuation fund industry, if I could say that, particularly in the industry side, should be pressing ahead with rationalisations to economic units, more competitive economic units.
So, sorry, you want the industry funds to take the lead on that?
No,
not to wait for it to be mandated, but to do it now.
Yeah, but within their own sector, their own sector, I think, you know, we've got to put a lot of the personality issues aside and try and we should reach a point where we end up with, you know, probably, I don't know how many years out, but at least 10 funds of $100 billion each, you know, under management. And
you're seeing, even as we speak, there are some improbable bedfellows. I think Media Super is joining in with CBUS. Now, you know, what the journalists and the construction workers have got to do with each other, not much. There's no obvious symmetry, but on the other hand, it's a fund that's going to emerge stronger for it. Yeah. It'll emerge stronger because the bigger corpus of funds will give the fund options it doesn't have now, you know. Well, the first thing to say about the retirement income review is that the terms of reference, which included an examination of the SG rising to 12, was a term of reference recommended by a Productivity Commission inquiry for which there was no authority. There was no terms of reference given to the Productivity Commission to look at the legislated 12% super. Nevertheless, that recommendation went on. The government accepted the recommendation and it set up the retirement income review on the basis that the review looks at the 12% superannuation. So there's an illegitimacy from the get-go about the retirement income review looking at the 12% because the Parliament has already decided on the 12%. That's the first. That's the main point I'd make. There are lots of issues in superannuation, management of funds, prudential issues, multiplicity of funds, performances, the interface of the pension system with the superannuation system. These are all legitimate issues for any review. And
And one hopes that any such review, and if we have had a review and the Treasurer's in the position of the review, that review does both shed light and recommend sensible things to do to make the interface of the pension system and the superannuation system more successful than it is now, including taper rates, etc. So the best thing about, rather than wonder about the review, the government should publish the review so we can understand what it is. But on the question of the SG, the Productivity Commission reference was an illegitimate reference because the Productivity Commission had no authority under its terms of reference to look at the SG already legislated. So if this review wants to get its sticky fingers onto the SG, it'll just shriek illegitimacy from the get-go.
Greg Combet, on early release, would you also call for I think publicly you've already said that the early release should end at Christmas, but would you call for a reinvestment system? In other words, and I know this to be true, many people have, and the savings levels in banks and other investments have shown, a lot of people took the money out of super thinking, well, this is a one only chance, 10, 20,000, and they've parked it. Should there be some incentive for people to put it back in if it turns out they parked it in case they needed it, if they don't need it in the next few months, to get them to put it back in?
Well, some encouragement would be welcome, of course. And I think Paul's made some very pertinent points about the early access scheme. I mean, as we now know, there hasn't been rigorous or any testing of the applications made against hardship criteria, so it's been a free-for-all. That really underlines the fact that it's a very large economic stimulus measure, now 30 billion plus, heading towards 40 billion plus. That's coming from the savings accounts, the superannuation accounts of young people and a lot of lower paid workers in the economy, whereas that stimulus measure should have been publicly funded. And that money's all gone straight into the banks, so it's also a very important source of liquidity for the banks. That to me just is all wrong. We've been very mindful, of course, of the fact that many members of SuperFunds would be confronting hardship in these times of this pandemic, and we're very sensitive to that fact. But that system clearly hasn't been directed specifically towards that objective. There are, as you pointed out, existing hardship provisions in trust deeds so that members can call upon, and I just think it's critical that at December 31, the early access scheme be terminated and we not revisit any public policy measure that breaks open preservation again. And we need to get savings rebuilding for those people who have cleaned out their accounts, the better part of 600,000 people. And the most important way of doing that is to stick with the legislated super guarantee rises commencing July next year.
All right, and we're just about out of time. From Bernie Dean and all the people at Industry Super Australia, we'll mask up again now here in Melbourne, and we'll also try and avoid the frostbite from the hail that you may have heard hitting the roof of the pavilion that we're in. Thank you all very much for joining in. We wish you all the best, and we hope to see you all again sometime soon. Thank you, Paul.
Thank you very much. Thank you, John.
Thanks, John.
Thank you, everybody. Good day.